to Navigation Trading Live. You are now part of a growing group of do-it-yourself traders who are trying to change the way investors think about building wealth. But because we don't believe in using financial advisors, stock tips, or traditional financial media, we have to do things different. We have to do things smarter. We do that through an art and a science we call trade hacking. At Navigation Trading, our methodology is based on statistics and probabilities, not hype or emotion. Our core strategies have been used by market makers, hedge funds, and floor traders for many years. Now, we share these secrets with you. Whether your goal is to make an extra $1,000 per month or replace your current income, with our guidance, you can achieve financial success beyond your wildest dreams. So, let's get started.
What's up, everybody? It is Monday morning. Not sure if that intro audio worked out okay. I'm actually traveling, so I am broadcasting live from a laptop this morning. So we always do our best to get this out because we always want to make sure we're consistent with our message. Always broadcasting live on Monday morning to bring some good content to everybody. So hope everybody had a great weekend. Excited for a new week of trading. Don't forget, this is all about you. So if you have any questions or topics that you want me to cover during the live broadcast, just shoot us an email or leave a comment here on Facebook or YouTube, and we will do our best to get it answered. Because of the equipment we're working with right now, this is going to be a little bit shorter broadcast than normal. However, I do want to remind everybody that we've got our new course out, now available, How to Trade Options on Earnings for Quick Profits. So this is all about trading options around a stock's earnings announcement, and we've gotten a ton of good feedback from those members who have already purchased the course and who have already gone through it, and they're really excited because the timing could not be more perfect. So, October starts the end of the fourth quarter, meaning the third quarter just ended. So all public companies are now required to come out and release their earnings announcements. So in the next few weeks, we are going to see a ton of earnings announcements. It's kind of what we call earnings season, where a lot of these stocks are coming out and telling you their projected sales, their past sales numbers, revenue numbers, debt, equity, any financials related to their company, and a lot of times that makes their stock move in a very specific way. And even more important than how the stock price moves, it's how the implied volatility reacts to that earnings announcement. And some stocks have very specific ways that they act around earnings. So they have very specific personalities around earnings. So if you're interested in this course, it is only available with this new special pricing until October 11th. So if you simply go to NavigationTrading.com/earnings, that's where you'll get to the information page. As you can see, that you've only got a little over 2 days left to get the course for only $49. At that point, it will go on the website for $199. So you're looking at a huge discount. So make sure you get that here in the next couple days so you don't miss out on that early bird pricing. We don't want you to pay full price. And this course is only available on NavigationTrading.com. So it won't be available anywhere else. So if you're interested, go check that out. All right, let's go to the platform and see what's going on in the markets. So we've got, let's scroll up here. And again, I'm working on a little bit of a condensed screen here, so hopefully it's coming out okay for you guys. Looks like stocks are up a little bit. S&P's up about almost 4. Everything's up just a little bit. Bonds are up a tad, pretty flat. The VIX is showing up over 3.5%, even though the VIX futures are down about 0.25%. So that's always interesting to see the difference between those. And I'm actually coming out with a course all about the VIX here in the next few months too, because there's a lot of nuances and different things surrounding the VIX that a trader can capitalize on if they know how to trade it. Oil's up a bit, gold up a bit, natural gas pretty flat to down. The grains look like they're down a little bit. Some of these emerging markets are slightly down. The euro pretty flat, and no other major movers here. Let's take a look at some of the stocks that we look at. Apple's up a little bit. Adobe pretty flat to down. Amba up a little bit. Just trying to see if there's any really major movers here this morning. And this is kind of what I do every morning when the market opens, just to give you guys an idea of kind of my thought process and how I go through this, my progression. Tesla's down almost 2%. Tesla's been pretty range bound lately. We've got earnings coming up here in the next month, and everything else relatively flat. So nothing real big. So what I want to do is I want to take a look at trading. Let's go back up to our ETFs, and I noticed that the Chinese large cap ETF FXI had some decent implied volatility. So with implied volatility fairly low across the board, FXI, the Chinese large cap, has a really high implied volatility. The IV percentile is 71, IV rank of 41, which makes that kind of our optimal target to sell premium in. And what I want to do here is I want to walk you through, because sometimes if we're selling premium, we're going to sell an iron condor, right? Sometimes we're going to do a butterfly. Sometimes we're going to do a strangle. And so let's walk through what we could do on FXI. First, we're going to choose the expiration between 30 and 60 days to expiration. Then once we open up that, we can look at, let's just start with if we put on an iron condor. So we typically like to do about the 20 delta is where we like to sell those. So if we sell an iron condor, and then so we're selling the 48, so let's say we buy 2 strikes wide, so that'd be the 50. So let's go ahead and change our other call to the 50, which it's already at. So that's the one we're buying. And then on the put side, let's go over here and look for the same, about the same delta, maybe the 22. So let's look at the 43.5 and the 41.5 on the put side. So we'll look at 43.5, and then we'll buy the 41.5 for protection. And so here's what I wanted to show you. So let's go ahead and analyze this so we can get a little bit better visual. What you're looking at here is if we hover over here with one contract, we're only collecting a credit of $41, okay? And our max risk is 159. Okay, so a couple things stand out to me here. One, the amount of credit that we're receiving, or our max profit, we want that to be at least a third of our max risk. Okay, and we're under that. So that's our first red flag of why I would not do an iron condor here. Second, we're collecting a credit of $41. Okay, remember we've got transaction costs involved here. So putting on the trade, we've got transaction costs. Taking off the trade, we've got transaction costs. An iron condor is a four-legged spread, meaning we've got 4 different options making up this spread. So we've got to account for the transactions there. So with the transaction costs involved, just the amount of credit, and this is if we get filled at 41 cents, we may have to give up another couple pennies, which even decreases our potential max profit. So for me, this doesn't make any sense to do an iron condor. And that's pretty true when you're trading a symbol under $50. It's just really hard to collect enough credit to make it worthwhile. So in this case, I would not trade an iron condor on FXI for those reasons. So our other options would be we could do a straddle, a strangle, a butterfly, and all of those options would be viable trades. So let's say, for example, we want to look at a strangle. Okay, so let's just use the same strikes, the 48 and the, what was the other one? 48 and the 43.5. So let's go ahead and sell strangle. Change this to 43.5. And now we're collecting 66 cents to put on the strangle. Okay, so that would be much better. At least that's going to give us an opportunity to make some profits, as opposed to with the iron condor, we're being eaten up too much in transaction costs. So we're getting a much higher credit, 66 cents versus 41. And remember, a strangle is only a two-legged spread. So we're just selling a call and selling a put, so we have half the transaction costs of an iron condor as well. Okay, so strangle would be one to look at. And then the other one that would be a potential, or straddle, which is just selling the at the money, which would be about the 45.5. If you wanted to get a little bit tighter around that, I would probably prefer the strangle at this point, since it's our first position that we would put on in FXI in this cycle. And the other option would be a butterfly. So I typically like to go on the call side. So you could right click right at the money and buy a butterfly. Where's my butterfly? Butterfly. And then let's take a look at where the what am I looking for? The expected move, about $2.50. And so that's where we would move our strikes to. So about $2.50 lower would be 43 and 48 on the upside. And so there you can see we're getting a credit of about almost $1. So if we right click on that and analyze our butterfly, and let's unclick our strangle here. So we're just looking at the butterfly. So you can see we get a nice wide butterfly, max risk $98, and we typically manage these at about 25% of debit paid. So we could kick that up several contracts. Of all these, I like doing a naked position best. So either a strangle or a straddle. You're still, with a four-legged butterfly, four-legged spread like a butterfly or an iron condor, you're still I think you're just getting eaten up a little bit too much in transaction costs to really make it a viable trade. I would go with the butterfly for sure over an iron condor if you really wanted to define your risk. But for me, I'm comfortable with undefined options, and so I would either go with a straddle if you want to be really tight, or my preference would be to go with the strangle that we set up, getting about 66 cents in credit. And that would look like this. And then if we set our price slices to break even to 11.18, and let's move that over. So we're looking at a probability of over 67%, and by closing our trades out at a percentage of max profit like we do, we're actually looking at closer to 80-85% probability of making money on this trade. So this is the one I would go with. I am going to stop the live broadcast now. I'm going to work this order, see if I can get filled. If I do, I'll send it out to alert subscribers. And if you're interested, if you haven't done a 2-week trial of alerts, we still have our special going on, $7 for a 2-week trial if you want to check that out. And then lastly, one more reminder, don't forget the earnings course is available for only $49 for 2 more days. Then it goes up to $199. So if you're interested there, go check it out. Everybody have a great week of trading. Talk to you later.